Hi, hello, welcome back to my channel Sri Studies. Today's class is legal requirements related to bank accounts preparation. So, the bank account regulations. I'm Srimati from Dr. Ambedkar Global Law Institute, Tirupati. Let us start the class with an introduction. What is bank actually? So, it is given in the Banking Regulations Act 1949. So, accepting for the purpose of lending or making an investment of deposits of money from the public to be payable on demand or otherwise and withdrawable by check, draft, order or otherwise. So likewise, it has been given according to Banking Regulations Act 1949 under section 5B. So we can simply say that to accept the deposits of money from the public and to lend or make an investment of those deposits, that is called a bank. So what are the legal requirements means? While preparing the accounts, bank accounts, it should be in a prescribed form which has been given under section 29 to 33 of Banking Regulation Act. In that third schedule, form A has been given for this preparation and with effect from this 1st April 1991. So we can simply say that the final accounts for the year ending 31st March 1992 onwards, we have to prepare in this new format only. Before that, they have to follow Companies Act 1956. So accounting year, it starts with on account of the amendment of provision of Income Tax Act 1961, which requires every company has to close its accounts on 31st March every year. So bank also a company, we are stating it. So with effect from the financial year ending 31st March 1989, now a banking company also closes its bank accounts on 31st March every year. So prohibition of trading. So here according to section 8, a banking company cannot directly or indirectly deal with the business of buying and selling or bartering of goods. So they cannot do it, buying and selling of goods. So except in some cases, that is realization of security given to or held by, that is the realization of security in the sense in case a loan has been taken by keeping a security of some assets, then they can realize it, or which can be held by the bank, then that can be, then engage in any trade, already they are engaging in any trade or buy or sell or barter of goods for others. So otherwise in connection with the bill of exchange or received for collection or negotiation or for administration of estates as an executor, trustee or otherwise. If the banking company is a trustee or executor, then they can do it. A non-banking asset, so banking company may have to take a position of certain assets which has been charged in its favor on account of failure of the debtor to repay the loan. When the debtor is failed to repay the loan, then the banking company used to take back the position of the goods or assets. In such a case, they can have that asset. That asset is non-banking asset. It's not a banking asset. And then the banking company cannot held any immobile property. So in case if anything has acquired, that is purchased, except for its own, then for a period not exceeding 7 years from the date of its acquisition, they have to sell it off. And then any gain or loss on sale of asset has to be shown separately in the profit and loss account of banking company. So what is it, Shar Capital? There is about a different slab of Shar Capital requirements which has been applied to the banks which were established before 1962. But after that, the Banking Companies Amendment Act 1962, they raised a minimum amount of value of paid up capital to 5 lakh rupees. So in any Indian company commences its business in India. Then now what is a reserve fund? How much they have to say? We normal people, how we are making a reserve for the future, the same way the banking company makes a reserve. So according to section 17 of Banking Regulation Act 1949, it's about an obligatory for banking company at least 20% of annual profit as disclosed by the profit and loss account before the dividend is declared. So 20% is obligatory. But as a prudential measure, banks have been asked to transfer 25% of net profit to statutory reserve. It is compulsory. Okay. And then the transfer of profit to reserve fund should be continued even the aggregate amount exceeds the reserve fund and the Shar premium account. And then according to central government's exemption towards it or the recommendation from RBI, they can contribute towards it. They can use this fund. And payment of dividend can be dealt in two sessions, 15.1 and 15.2. The 15.1 gives the company cannot pay its dividend unless the capitalized expenses or share selling commission brokerage amounts of losses incurred or any other item of expenditure which has not been represented by the tangible assets are completely written off. That is, they have to pay the dividend after all this capitalized expenses should be written off. Likewise, it is given in session 15.1. So in 15.2, it has given that they can pay the dividend but without the writing of certain items. In the value of its investment in shares, debentures, bonds, and such a provision is already satisfied by the auditors. And in case of bad debts, the same way the adequate provision has been done according to the satisfaction of auditors. Then they can declare a dividend without writing of these items. The restriction on payment of commission, brokerage, discount, etc. according to section 13 of Banking Regulation Act 1949, there is about a restriction towards it for issue of shares of a banking companies. There is no banking company can pay directly or indirectly these things, that is payment of commission, brokerage, discount or remuneration, whatever it is, that total amount should not exceed 2.5% of paid up value of such a shares. The restriction on creation or unpaid capital. So that is creation of charges here. So according to section 14 of Banking Regulation Act, the banking company cannot create any charge on its unpaid capital. Since it is not paid, they can't create any charge over it. So 14A, banking company cannot create a floating charge on the undertakings or any property of the bank except with the written permission from the Reserve Bank RBI and certifying the charge will not detrimental to the interest of the depositors. And a restriction on acquisition of shares of a subsidiary company. So according to section 19 provides a banking company can only form a subsidiary company for the following purposes. So undertaking or executing trust, undertaking of the administration of estates as executor, trustee or otherwise, providing for safe deposit wallets, and carrying on the business exclusively outside India with the permission of Reserve Bank of India. So such other purposes as or incidental, that is which is relevant to the business of banking with the permission of Reserve Bank of India. So but whatever it is, the banking company cannot carry on a trading activity by acquiring or controlling interest in a non-banking company. Cash reserves, this is CRR. Already you know this according to section 18 of Banking Regulations Act. So every, that is a non-scheduled bank is also required to maintain a cash reserve either by themselves, that is with the bank or with the RBI, with an equal amount at least 3% of its total time and demand liabilities in India. So according to section 42 of scheduled bank is also requires to maintain with the Reserve Bank of India a daily average daily balance of 3% of its total time and demand liabilities in India. So here RBI has the power to increase this percentage 20% with the notification given in the official gazette. But present CRR is 4%. Statutory liquidity ratio SLR. So according to section 24 2A of Banking Regulation Act, every banking company in India, whether it's about a scheduled or non-scheduled bank, they have to maintain the cash or gold or unencumbered approved securities with an amount which is not less than 25% of its demand and time liabilities in India. So here This is called the statutory liquidity ratio. So the Reserve Bank has the power to increase the ratio to up to 40%. The present SLR is 18%. The restriction on loans and advances. So they can't simply give loans to its shares, to its own shares, which has been given under Section 20 of Banking Regulations Act, but which has been amended in 1968. So they cannot grant any loans or advances on a security of its own shares, as well as the bank as banking company can enter into any commitment granting any loan or advance to or on behalf of any of its directors or any firm which any of its director is interested as a partner, manager, employee or guarantor, or any company other than it's about subsidiary company or company registered under Section 25 of Companies Act or a government company. So in anything that is a relator, the director is a director. The banking company's director is a director, manager, employee or guarantor in which he holds a substantial interest, or any individual in respect to of whom any of its director is a partner or guarantor. So in such a case, the banking company cannot grant any loan or advance on its behalf. So limits as to investments in shares and debentures. So before it has a number of restrictions related to investments, but RBI has removed these limits on investments made by the bank in equity and debentures and issues of 17 financial institutions. So here there is about a simple example related to this institutions: IDBI, IFCI, ICICI, Exim Bank of India, that is Export and Import Bank of India, then RBI, NABARD, then Tourism Finance Corporation of India, like it goes on. So all these limits as to investments has been removed by RBI. Hope you understood. Until the next, it's bye from Srimati. Thank you. Stay tuned.